That's what I think of the market today. Oh, so beautiful. So beautiful. Okay, what happened? Where am I? What dimension is this? I don't know. All right, we finished flat on the Dow. S&P higher by 0.5%. Nasdaq higher by 0.78%. We had gold, the futures ending above 1900. We had oil, which took a dip during the day, which I'm going to talk about a little bit, ending above $70 again, putting on a slight gain. We had silver putting on 0.5%, ending above $28. We had the dollar falling just slightly at 90.065 when I just checked it 2 milliseconds ago. It did actually dip below 90 for a couple minutes, and then it was brought back up, but it still finished the day lower. And what are we all thinking about? We are talking about the CPI number and the jobs number, the unemployment claims that came out earlier, which I didn't even talk about in my pre-market because I was so focused on the CPI. And I think that's what you should be focused on. It's definitely the most driving force today because the jobs number, even though we found out another, I think 364,000 people applied for first-time unemployment, which is absolutely abysmal. Very sad for these people who are losing their jobs. But clearly the driver today, to me, was this inflation data, and we have a lot to parse through in terms of what future expectations we're going to hold for this market. Now, the first thing I noticed when I was getting my stuff together for this video was the 10-year yield. Okay, it was higher after the inflation data, and I mentioned in my video, I said, okay, it's anticipating the inflation. What happened to the 10-year yield? It reversed and ended significantly lower than it started the day at 1.452%. Big picture, still don't see this as a huge fear reaction. But I think there is a lot of risk in this market, and that might be playing out a little bit here with the way the 10-year yield is falling. But I did a little more research, and I saw a couple of things, but the principal one being municipal bond fund flows are surging. Okay, now why would somebody be buying municipal bonds in a highly inflationary environment? Even if it's transitory, why would you be doing that? It makes zero sense, because you're getting like less than 1% return. The CPI is at 5%. So the real yield of the 10-year yield today, which isn't a muni obviously, is like negative 3.5%. Okay? So I don't know who the hell is buying the 10-year yield. Actually, I do know. Who has the money to invest? It's certainly not the people. We're broke as hell. I mean, we don't have any money. Even the rich are nothing compared to the banks that, if you've been looking at reverse repos from the Fed, they have nowhere to park their cash. They are awash with cash. So what are they doing? They're buying up bonds to just try to find some sort of yield to get by. Now, in a real market, you might see banks buying, I don't know, gold, or I don't know, silver, or I don't know, Bitcoin, which they are buying, and it is less rigged than the prices of gold and silver. But no, we don't have a real environment. We have a totally fake environment, and that's why you're seeing what you're seeing. You're seeing things that are literally the opposite of what you would expect, right? I mean, inflation hits 5%, highest level since I think 92. Oh yeah, bond yields fall. Yeah, that makes a lot of sense. Okay? I don't even know. And so then I looked at this article. It said, worried about inflation, how to position your retirement accounts. And instantly, what I thought of is this. The education system and the media is designed to have you think that IRAs are safe and that certain investments work in certain time periods, and this is just a total farce, okay? the first thing they talk about is say, oh, well, maybe Treasury inflation protected securities are the way to go. Well, they have a 2% annualized real return during the 5 most recent periods of inflation. And they're saying, oh, this looks promising. This is, wow, this is interesting. And then they go to commodities. Traded commodities, which I don't know exactly what they mean, but I'm assuming copper, lumber, oil, and I would think gold and silver as well. They have a perfect track record of generating positive real returns doing the 8-period studies. I don't know why they went 5 and 8, but whatever. Averaging a 14% annualized real return. So 7 times higher than tips. Just a little bit better, But tips are promising, The first one they're going to mention, of course. Whatever. I'm getting too critical here. But the real beef that I had with this article, and again, the media, the education system design, and I'll get to the education system too. I got no punches to pull on the education system. But they say gold is also too volatile. I'm sorry. Gold is too volatile as a reliable hedge against inflation. Okay, this is the only thing you need to know about gold. In ancient Rome, you could buy a very nice toga, which is what they wore. The royal people had a nice purple sash across, hang down, whatever. You could buy that for an ounce of gold. Today, a nice suit going to cost you about $1,500, $2,000. It's an ounce of gold. Gold holds its value, okay? Period, end of story. And there are inflationary periods that you can look at where the returns on gold are absolutely staggering. And it's my opinion that because of how rigged the prices of gold and silver have been in this era, specifically since 2008, the opportunity here is so massive that I almost can't describe it. I think that silver, for example, in the next 5 years is going to go over $200 an ounce. Okay, I think that gold in the next 5 years is probably going to go to over $10,000 an ounce, and I think both of those estimates, particularly the one on silver, are conservative for the next 5 years. Okay, you look at the 1980s and the 70s. I mean, gold was $35 an ounce when we took off the gold standard, and we had inflation, stagflation, and it ended at the high around 800, and it in 2000 it was like 250. But even if you annualize the returns on gold, it's just about as good as stocks since 1971. Okay, and so we're at a period in time where if you look at the ratio between gold and silver and the stock market, say the Dow Jones, the Dow gold ratio, they are at historic highs with relative to how much more valued is the Dow Jones than the price of gold. And so I just think these are such great assets, because even in this article, they say basically stocks are pretty flat in a stagflation environment overall. So gold and silver is where you want to be, period. Okay, if you're trading the shit like me and you have options on these gold stocks, it's a much different game. Okay, you have to be a lot more careful with how you allocate your money. But if you have, say you have parents, right? They have money in an IRA. Look, we are taught to think that an IRA is the safe investment, but we are in no man's land. We have never seen what is happening right now with regards to the Federal Reserve's balance sheet and the way the assets are being inflated. Okay, and so IRAs, where you can't really move your money around the same way you can in a regular brokerage account, are not safe at all, because let me tell you, it will flip on a switch, okay? It will flip in a second, a millisecond, okay? And everything will disappear. And if you're not in the right spots when that happens, when things freeze, you will be screwed, and there will be no way out at that point. Assets like gold, silver, and crypto will go through the roof instantly, and that's just how it'll work. You will be seeing 100% gains in one day, maybe more. The time when it happens is going to be so staggering that I don't think people can really fathom it. But again, we're in no man's land. We've never seen this kind of monetary policy, and it's just a matter of time, people. It's just a matter of time. Okay, so I wanted to get into another thing too. So this article, they talked about inflationary periods. We've been in an inflationary period since the inception of the Federal Reserve. Okay, doesn't mean there haven't been, it's an upward trajectory. But you have dips in there. You have times when inflation is pushed off, mostly because of the staggering amount of productivity that we've seen with regards to the technologies that have been created in the past 100 years or so. But I wanted to look this up, and so I looked up total assets for the Federal Reserve. The chart only goes back to the 90s, or maybe like the early 2000s. It was very hard to find total assets of the Federal Reserve since their inception, but I did find it, and I'm going to link it to you in the description of this video so you can see for yourself. But I'm just going to put out a couple of data points here so you can see that we're constantly inflating the money supply, okay? We're constantly doing it. So I don't care what they say the CPI has been or is right now. I don't care anything. What I care about is the money velocity, the rate at which cash is flowing through the economy, and the amount of cash that is flowing through the economy, that exists, that could flow through the economy, okay? In 1914, November 20th, 1914, the first data point they have here, the total assets were $247,158,000. That's fun. Okay, now let's jump to, let's go to the Roaring 20s. Holy moly, we're already at $5 billion in 1924? How did that happen? Wait a second. $5 billion? Okay. Alright, wait, let's go after the Great Depression. Let's go to 1934. Oh my god, we're at $8 billion already? They almost doubled again in 10 years? Alright, let's jump over to after World War II. Wait, what, $44 billion? Excuse me? That's 4 times in 10 years. That doesn't sound right to me. Alright, let's jump another 10 years. Oh, all right. Hey, only $52 billion in 55. That's not too bad. What could possibly go wrong from here? All right, let's jump to 1960. $54 billion. Okay, so the 50s and the 60s, only mildly inflationary, still rising. All right, so 65, and now let's go to 75. Oh, another doubling to $111 billion. That's not very fun. Let's go 85. Oh, another doubling to $200 billion. Let's go to 95. Oh, another doubling to $400 billion. Let's go to 2005. Oh, another doubling to $800 billion. Every 10 years it doubles. And what have we seen in the past year? It has doubled in 1 year from the COVID crash. Who's gotten more powerful during this stuff? The banks, of course, the rich. We suffer, period. You don't like that? You don't believe it? You don't follow it? Get off this blog right now. That's all I can tell you. 2004, 2014, over quadrupled. And so when I talk about the Federal Reserve balance sheet going to 20 trillion very soon, I mean, get a grasp on this stuff, because it is, and people have never understood this, at least the population has never understood it, never fought back against it. People should be up in arms about this. But no, the Federal Reserve is allowed to continue acquiring assets, buying the entire world, with nobody saying a peep about it in the mainstream news. And they also push you into these IRAs, which they will snap and make disappear the second they allow this whole thing to crumble down. And they flip the switch, period. What the switch will be, I don't know, but I know that they flip it. Whether it's war, military, just a simple banking problem, or a contagion effect among the banking system, doesn't really matter. You just have to understand that it's coming. You need to get yourself at least partially allocated to some of these assets. Try to convince people your parents, everybody, to get out of these central bank assets and into some of these other things like cryptocurrencies, like gold and silver. And gold and silver, they've been systemically vilified. My grandpa was one of these people who, basically was like, oh, well, it doesn't return anything, blah, 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 And I get all of their arguments. They're all pretty much valid to a certain extent, but they don't understand the core dynamic, which is really, the heart of it. And that's the constant inflation and the flipping of the switch. The other thing I want to mention, I mean, the Great Depression, it was an inflationary bubble created by the Fed and their low interest rate policies. So they've been engineering these crises literally since, the Great Depression and before. If you want to read a book on that, it's a long read, but it's Murray Rothbard's The Great Depression. Highly, highly recommended, but very technical, very economical, but I mean, it's pretty amazing when you look at everything that was happening, like a central banker, I think Benjamin Strong, getting in contact with the Europeans, and they're doing dollar swaps, and they're figuring out how they're going to maintain this and how they're going to inflate. Like, all of these were caught in letters and everything, and it's like they put their motives out there in the front. You don't need to look that far to understand what they're doing. And I did want to get to this oil thing. I mean, it was comical, man. You saw oil drop over $1 in the space of like 10 minutes today. And what happened? And well, it was because of this article from the Wall Street Journal. U.S. lifts sanctions on more than a dozen former Iranian officials, energy firms. Okay, so we're lifting sanctions on Iran, and the theory is, they're going to produce oil and it's going to filter in the market, more supply, same demand, prices go down. Oil finished above $70 a barrel. It was bought up instantly. Okay, and this is what I've been telling you about crude oil. It won't be. It's not allowed to fall. Not even for one day. I mean, how ridiculous is it? And don't get me wrong, oil will fall. It will correct at certain points, but again, getting on the long end of this stuff, allocating slowly, dollar cost averaging, all this stuff, if you get on the right trend in this market, you will make money. And if you know the dynamics that indicate trend switches, such as the dynamics of the 10-year yield, dollar, and oil, you will be a big winner today. And the amazing thing too, I mean, I've told you guys and girls, I'm in gold stocks. I have options on these gold stocks. Well, gold barely finished positive today. The futures ended up above 1900, but my favorite gold stock, Barrick, ended up 3%, and the GDX, which is an index that tracks gold stocks, ended up, I think, 2.5%, so big rallies in the gold stock sector, and they're starting to anticipate this inflation. They know kind of what's going on here, and I think that this is going to continue. The dollar, where it's at, I mean, it's going to break below 90, people. And when it decisively does, like I've been saying, it's going to be pretty epic, I think. We'll see, though. We'll see. All right. I think this video has been long enough. I have no idea how long it's been. Okay, it's been pretty long. But this was a freaking great one. I mean, one of the best, probably the best one I've done. I think this video contains so much good information. So please share it. Get this information out. I mean, this is kind of stuff that normal people can digest. Anybody can go to the description of this video and look at the link and see how the Federal Reserve assets just go up in a straight line for 100 years. And think about that. It's really not rocket science. It's pretty simple to understand. But you have to understand that it's a game, right? People want things to be real. They want it to be a certain way. They hope it's going to be a certain way, but no, this is reality. Let's work with it, okay? All right. I will see you tomorrow morning. I love all of you. I hope you hit the subscribe button. I hope you hit that like button, and I hope you enjoy this stuff. That's really all it is. All right. See you later.